Lyn Alden answered some important questions like regarding the performance of gold and silver, inflation and deflation, etc. Addressing gold's situation right now, Lyn replied that we have been in a correction ever since August of 2020. So the two major metrics to monitor gold are growth and broad money supply and the real interest rate. So over the very long term, gold generally keeps up with broad money supply growth, and you can think of it as the inflation rate for gold is somewhere around 1.5% due to mining. So that's the inflation rate that goes up. Whereas if you have a monetary inflation rate of 5%, new dollars being created every year, then generally you would expect that the dollar price of gold would go up over time. And that's generally the rate that we have seen it grow at, more or less depending on exactly what time period you are looking at. If you have a sufficiently long period of time, it basically tends to keep up with what you would expect now. It can go way above or way below that trend, largely based on real interest rate. So that's like say a 10-year treasury rate minus the inflation rate. If you look at the 1980s, after gold had that big spike, it then went into a 20-year bear market. Even though inflation was still kind of hot for a while in the 1980s, the issue is that you had really positive real rates. For example, if let's say inflation is 4% a year, but treasuries are yielding 7%, so you get a 3% real yield on your treasury just by holding that very safe asset. So the opportunity cost for holding gold, which is a yieldless asset, is pretty high, and so gold is not very desirable. Then let's say fast forward, you have an environment where inflation is 3%, so it's even lower. But let's say the 10-year treasury is using 1%. That means you are getting a negative 2% real yield on your treasury. Suddenly that zero yielding scarce gold asset looks more attractive. So gold has a very strong inverse correlation with real yields, and that's stronger than its correlation with the dollar. That's stronger than most other types of correlations. That's really the most persistent correlation it has. You can think of it as gold generally follows the broad money supply growth, and it goes above it during period of low or negative real interest rate, and it goes below it when you have really strong positive real rates. If you look at where gold was back in 2018, we hit a peak in real yields. So the treasury was yielding over 3%. Inflation was about 2% by official ways to measure it, which is because gold is largely a paper market. Where gold fluctuates up and down around is based largely on real interest rate. So that's the short-term driver. Whereas the long-term driver, it's going to stick very close to the broad money supply growth. But guys, Lyn believes that silver is a much messier market. She says that one of the reasons that gold is such good money historically is that it has a high stock to flow ratio, meaning that the amount that you create every year is low relative to the amount of that exists already above ground and in investment form. So it's not like you are heavily tied to what's happening with mining. It's more like a currency. In addition, the vast majority of it is for monetary use, either outright coins and bars, or funds, or in many cases, like jewelry demand, of which is a significant segment like in India, is for wealth preservation. So overall, there's a very big chunk of it that is for wealth and a very small percentage of it that is for the industrial usage. Whereas silver is a weird hybrid because it's not like copper or oil where they are pretty much purely for the industrial use. But it's not like gold where it's almost entirely for wealth and destroying and displaying wealth. It also has a stock to flow ratio which is not nearly as high as gold, but it's way higher than pure industrial ones like copper or oil, and it's kind of got that hybrid status. So a general trend is that you can't monitor it in the same way that you do gold. But generally, when gold is in a bull market, usually silver is doing better. When gold is doing very strongly, especially if you have gold rising due to disinflationary conditions, silver does pretty poorly. Ever since we came out of March 2020 bottom, silver did better than gold because that's a more inflationary environment. We had a very sharp increase in the broad money supply. We had rising inflation expectations. If gold does well in the 2020s, it wouldn't be a surprise to see silver do better. But you can't track it next to broad money supply and the real interest rates. It doesn't really have that tight correlation that gold has because it's not a pure currency in a sense. When you string multiple short-term business cycles together, you get higher and higher debt as a percentage of GDP, and you get lower and lower interest rates over time. And eventually what happens is you get extremely high debt levels and interest rates hit zero. So basically monetary policy runs out of room. They turn to asset purchases, but those are only so effective. So that's where you get that huge kind of debt bubble. That's kind of different this time. Over the past decade, we have had more debt in the system as a percentage of GDP than any time in history, and the only time comparable was the 30s and the 40s. Back in the early 30s, you had a private debt bubble. In the 1940s, you had a public debt bubble. So we have kind of gone through the same pattern, wherein the 2008 period and then deleveraging into the 2010s, that was a private debt bubble. Then we built that up into a public debt bubble that really kind of came to fruition here in 2020. So in a sense, private debt is deflationary. All that debt in the system, that's the risk of causing a deflationary collapse as per Lyn Alden. Then you have technology, which is good form of deflation. You want prices to go down. You want your money to be worth more than you have. Offshoring, which is really good for people that didn't lose their jobs to it. So if you work in technology or healthcare or in government, it's good that your products and services are cheaper. But it's bad if you worked in the industries that made those goods, or if your job got replaced by technology and automation. So that kind of bifurcated society. We have worse demographics, lower population growth, older population, and all those forces are deflationary. Inflationary impulse, if large enough, can cancel out both good and bad types of deflation. Whether it's a bad debt deflation or a good technology deflation, inflation can come in and just wipe that out. So guys, here is the end of this video. I would like to know your thoughts in the comment section below. Smash your thoughts there. Also, if you found this video really knowledgeable, then please subscribe to our channel, convert that like button into blue. I'll see you in my next video. Till then, have a great day.